United Airlines results topping first quarter estimates despite a $200 million impact from the temporary Boeing grounding. Airline also noting several adjustments to its long-term fleet strategy. Here for a closer look, let's bring in Peter McNally, Third Bridge Global Sector Lead for Industrials, Materials, and Energy. Peter, it's good to see you. So listen, they report, investors clearly like it. The stock is popping in the after hours. Give us your take on the results, Peter.
Well, I think it comes down to expectations, and they were pretty low. Let's face it, these are some high-profile issues that they faced during the quarter around the Boeing 737 MAX 9. Maybe not quite as bad as those, as those low expectations. But the key thing, or the key things going forward, will be the outlook. And clearly, they're going to get fewer planes than forecast. So we've seen CapEx get cut. Eventually, they're going to spend that money. So instead of $9 billion, it looks like $6.5 billion will be, the number this year, and they'll get 40 fewer planes. But, if they want to get to their 2026 targets, they're still going to have to take delivery on that. And that's dependent on Boeing, and we all know what is happening there these days.
Yeah, definitely. I mean, we see that they're planning on CapEx going further out to 2025 to 2027, still at $7 to $9 billion per year. But how much faith can we have in a forecast that far out at this point?
Look, there is a shortage of planes. There's no doubt about it. And it's not something that Airbus can just fill. Capacity takes a long time, to add. And Boeing's issues, predate the pandemic. They would have run into this situation had it not been for the 737 MAX crashes that they had in 2018. It's just manifesting itself right now that they can't deliver all these planes. So, we've seen the value of existing aircraft and engines go up, as a result. So one area that our experts have pointed us to have been, leasing, that they do have pricing power there. But look, United is still going to need these planes, and that's why they're just pushing out CapEx. If there's one thing we've learned from the pandemic, people still want to travel by air. And arguably it's come back even stronger. Business is a little different. It's a smaller part of the top line, but still important for profits. But passengers do want to travel, and that's what we're seeing.
And Peter, another issue here, the FAA increasing oversight. Peter, after these series of, look at a headline, making mishaps, any kind of line of sight into what comes next there?
It's just more scrutiny from the government all over this industry, right? And it's not just United and Boeing. I mean, there have been lots of things around the mergers and financings that are going on here. So it's frankly just a fact of it's a regulated business anyway. There are issues with air traffic controllers as well. It's not making it any easier to be an airline, these days. The underlying, the positive thing here, as we said earlier, it's just people want to travel. And you're seeing healthy demand. Pricing, is actually firming now because we can't get enough of these planes. But the government's likely going to slow down the amount of capacity that, that's available to consumers.
Peter, we know that United and Alaska are sort of the most exposed to the Boeing issues. Do you think that, if you're looking at buying an airline stock in this environment, do you think that others like Delta, for example, would be better positioned?
I mean, of the big ones, right? I mean, Delta has got the best balance sheet. It's a diverse fleet. And maybe most importantly, having their own MRO business, the maintenance, repair, and overhaul business, in-house, makes a difference in keeping planes in the air. We haven't seen a whole lot of issues with aircraft that's, been in the fleet, for a while. It's these new planes where these problems are coming up, whether they get delivered or, the issue that we had with Alaska back in January was on a new delivery. So that's where the challenge is, and that's not the challenge that Delta is facing. So it's a bit of a unique situation, right? United has the most ambitious growth plans of anyone, and long term they're probably going to be right that the demand is there, but they're really tied to Boeing. American, they kind of fall in between. Southwest has been more of an operational struggle, particularly around IT. They're addressing it, And they too, like United, have taken down their delivery forecast of new Boeing planes. Their existing ones are running fine, but that's kind of how we see the sector playing out.
Peter, what are jet fuel costs doing right now, and how are the airlines and your coverage universe navigating that?
Well, they're on the rise. The oil market has gotten tighter, or at least the expectations are that the oil market is getting tighter in the months ahead. We've seen inventories rise, through the winter, but OPEC stepped in and, extended cuts. And as we look to stronger seasonal demand, it's not just air travel, but it's, summer driving season and things like that. It's going to be a tighter market for oil, and that's going to flow through to jet fuel. Now, are prices likely to run away like we saw 2 summers ago? Highly unlikely. U.S. production continues to grow. We have refining capacity. Delta, again, they have their own, refinery down there in Pennsylvania that offsets some of this. But it is another kind of headwind, I would say, in the summer season for the airlines. But again, the demand is there.
Peter, thanks so much for your perspective. Really appreciate it.